Hi, this is Mike Larson for Money and Markets TV. Well, folks, the recovery that never really felt like a recovery for most of America is now over. Finito. Done. After yesterday's market crash, that's the only conclusion a rational investor can come to. The Dow plunged more than 500 points, and the percentage losses on the NASDAQ and S&P 500 were even worse. We've now given up every last penny of gains for the year and then some. And then there's the economic data. Yes, we did get a largely positive employment report today, showing the creation supposedly of 117,000 jobs in July, but frankly, I don't buy the news. And even if it is accurate, that doesn't nullify the terrible data we're seeing in other segments of the economy. For example, earlier this week, another benchmark measure, the ISM Manufacturing Index, missed estimates by a country mile, falling to the lowest level in 2 years. In addition, personal income rose at the slowest pace since last September, while personal spending actually fell 0.2% in June, the first decline in 2 years. Meanwhile, outplacement firm Challenger Gray & Christmas said planned corporate layoffs soared 59% from a year ago, and total job cuts surged to more than 66,400, the highest level in 16 months. And what about gross domestic product, the broadest measure of a country's economic output? It grew a pathetic 1.3% in the second quarter. Worse, the number crunchers in Washington slashed the first quarter figure from 1.7% all the way down to 0.4%. Now, were they lying to sugarcoat the truth when they reported the original better numbers? It's not for me to judge, but the unbelievably large revision and the awful Q2 numbers suggest the economy is rapidly tumbling toward recession. Of course, if you've been listening to my commentary, you were completely prepared for this turn of events. All the way back in May, I warned that the latest economic data suggested that we were hitting a wall. I pointed out that asset inflation was pushing us toward a tipping point, which would plunge the economy into a recession. And then a few weeks later, I ramped up my warnings, saying that all the borrowing and spending was becoming too much to bear. All the while, I've been urging you to take profits on long positions, dump stocks in sectors like banking, construction, and retail, sell your holdings in real estate investment trusts, and stop listening to the happy talk coming out of Washington. I also told you to start going on the offense, using inverse ETFs and other tools I favor in my trading services. The bottom line is, you've been warned repeatedly to prepare for tough times ahead. So hopefully, you were able to actually make money during this market losing streak. But if you haven't yet taken steps to protect yourself, the good news is there's still time to get your portfolio properly positioned. But you have to shift your thinking and do so right away. In a bear market recession scenario like we had in 2000 to 2002 and 2007 to 2009, you don't want to buy dips. You want to sell rallies. Or better yet, use those rallies to buy more inverse ETFs for the next leg down. Take this week. After such a nasty spill, we're likely to get a short-term rally soon. But that's not a rally you want to buy into. Instead, use that rally to dump stocks that got hammered in the preceding downdraft. I'd also use them to initiate fresh inverse ETF positions or add to existing positions in those vulnerable sectors, which include real estate, small capitalization stocks, and energy. I'm Mike Larson for Money and Markets TV. Thanks for watching.